Good morning, everyone. Thank you for joining us for today's webinar, Shifting the Business Infrastructure, How COVID-19 and Election Results Can Influence Your Estate Planning Strategy, presented by Rain Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. When you receive this email, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important to us as we determine future webinar topics. Also, if you like a copy of today's slides, you will find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webinar will be given by Inez Bowie and David Shallenberger. Inez is Senior Manager at Rain Associates with more than 20 years of accounting experience. Inez's primary focus is in tax, where she specializes in tax and estate planning, estate and trust tax compliance, and business and individual taxation. David, a senior manager at Rain Associates with more than 10 years of accounting experience, primary focus is in tax, where he specializes in tax services, business planning, and spending a significant amount of his time working with clients in the oil and gas industry. And now I will pass it on to you, Inez.
Thank you, Imani. Well, hello all, and thank you for joining us today. I hope you're having a great week. We will get started by sharing our agenda. If you'll go to the next slide. The agenda for the next hour is designed to give you information regarding the impact of COVID-19 and the upcoming elections on the estate planning. And I promise that this will in no way resemble the presidential debates from the other night. First up, what even is an estate plan and why do you need one? Second, how might the COVID-19 pandemic affect your overall planning? Third, what might we have in store after the upcoming elections? And at last, we will highlight some high-level planning ideas. Next slide, please. So what is an estate plan? An estate plan is a plan for the management and disposal of your estate, which is made up of everything you own. And it's a plan that can work during your life and after death. It's usually designed to minimize taxes, such as the gift, estate, and generation skipping transfer tax, as well as income tax considerations. So why do you need one? Well, without a written plan that spells out your wishes, state law and the courts decide who gets what. And if you think that works well, I encourage you to do a Google search for celebrity estate planning and see how that worked out for folks like Prince, Michael Jackson, and Aretha Franklin. You can learn a lesson or two from celebrities who pass away without a will or trust. And even though your wealth might not be in the same ballpark, it's easy to see how long and how costly the battles are when you pass without a plan in place. Next slide, please. So what are the benefits of estate planning? Why should you have one? Well, first of all, you're providing a method of taking care of your family when you aren't able to be there to do so. It ensures that your property goes exactly where you want, and it helps minimize your tax exposure and expenses. It allows you to be prepared for any kind of incapacity. And if you are a business owner, it's very important to allow for the smooth succession of your business to the next generation. Next slide, please. So how has the COVID-19 pandemic affected our estate planning or caused us to change our mind in some of the estate planning design? Well, COVID-19, as you know, affects people very differently. Some people who are exposed are asymptomatic and all is well. For others, it could mean that you're hospitalized, that you're on a ventilator, and that you're incapacitated for a period of time, which could be days, weeks, or longer. And unfortunately, some will not survive. So if you are one that ends up incapacitated, what happens when you're not there to take care of your financial needs or your family? Who's paying your bills? Who's checking with the hospital to make sure you're receiving the care that you need? It's difficult to manage your finances and your health in times like these. So now's the time to take the steps to prepare so that when something happens, somebody else can step in and help manage your affairs. Next slide, please. So now we're going to talk about some of the more general estate planning documents that are more than likely necessary to some extent. First on the list is the last will and testament, which allows you to name the executor that you want to handle the distribution of your estate, to take care of your final debts and your expenses. And probably most importantly, if you have minor children that will need to be cared for in the event of your death, this is the document that will more than likely allow you to name a guardian of your children. If you do have a plan in place and you have a trust set up already, then it's quite possible that you have what is called a pour over will. And a pour over will basically says that if I haven't put something in that trust that I have already established, then I want my assets to pour into that trust and then be distributed according to that trust document. So it could be that you have a very simple will that basically just says everything goes to my trust and gets distributed from there. So you might wonder, why do I need a trust if I have a will, or vice versa? Well, that's a good question, and so let's try to address that. As you know, or may not know, if you have a will, you tell the courts where you want your assets to go, but there's a probate process to do that. And so there's court costs that are involved in a probate process. It also means that your will is filed with the courts and it spells out your wishes and are open to the public. And while I doubt that there are very many of folks out there that are on the courthouse steps waiting to see what your last will and testament says, again, some people that are in the public eye, if you look at the celebrities, those wills, that's the reason we know that they didn't have very good planning. A trust, on the other hand, avoids the probate process. It allows for more privacy. It continues after death because you've already named a trustee. So it continues as if nothing ever changed. It allows for your financial needs to be handled by the trustee in the event of death or incapacitation. And you don't have the need for the court cost. So in some cases, a trust might make sense. In other cases, a simple will do. And that's where you have to make sure you're reaching out to your financial advisors, your accountants, and your attorneys to know what the right plan is for you. Next, let's talk about a durable financial power of attorney. Sorry, if you'll go back one more slide to the other slide. So this is a document that can allow someone to manage your financial affairs when you're living but unable to do so. So if you don't have a trust and you do have a living will, you want to make sure that you have this, or that you have a will, I'm sorry, not a living will. You want to make sure that you have a durable financial power of attorney, because this is the document that will allow someone to basically handle your financial affairs on your behalf when you're not able to do so. The next 3 documents on this list concern your health care. The healthcare power of attorney allows someone to make medical decisions on your behalf. And the HIPAA waiver allows your agent to access your medical records. And the living will is the one that defines your end of life care wishes. And I just want to point out too here, in light of COVID, if you have a living will in place, you might want to take another look at it to see what it says about things like being ventilated. If that's something that you had originally been opposed to and it says that in your living will, and now we know with the coronavirus that you might have to be ventilated in order to get through a tough period of time, hopefully able to come off the ventilator, you might need to change that document or tweak it so that your wishes conform to what's going on with the coronavirus environment. So it definitely warrants another look. And that will bring us to our first polling question. If you'll go to that, Amani. And the question is, do you have an estate plan in place? And it's a simple yes, no, or not sure. We'll give you a minute or so to answer that. And it looks like we are doing better than the entire US population because 63% of you do have an estate plan in place, and that is well above the US population. For those of you that say no, excuse me, or not sure, then hopefully today will give you some ideas of things you need to be talking with your attorney and your accountant and your advisors about. Let's go to the next slide, please. So next, we're going to shift gears a little bit to talk about how the upcoming election results might affect your estate planning and gifting decisions. As you know, the Tax Cuts and Jobs Act was signed into law by President Trump on December of 2017. This law doubled the basic exclusion amount from $5 million and indexed for inflation to $10 million indexed for inflation. For 2020, that exemption amount is $11.58 million. So that means each of us has $11.58 million that we can gift during our lifetime or at our death, estate tax free. Next slide, please. So let's take a quick look at some historical data here. And you can see I only went back to 1997, which is about the year I started practicing. So that's why I chose to start there. The estate tax exemption amount was $600,000. And since that time, it has gradually increased. You'll see in 2010, we went from 3.5 million and 9 to 5 million or 0. That was the year where basically it was the best year to die if you were in that situation, because that was the year that the estate tax was repealed. But then there came this other law change that said, or if it's not, if you don't choose to have it repealed for that year, then you can choose to have a taxable estate. As long as you're under this $5 million, you get a step up in basis and everything goes smoothly. So here we are again at a crossroads, because in 2026, the tax law sunsets back to the pre-2018 provision, which is an exemption level of 5 million indexed for inflation. And as you can see, historically, we have a 40 we've started at a 55% top estate tax rate, and we're now at a 40% top estate tax rate. So for 2026, we revert back to a $6 million estate with a top rate of 40%. It kind of sounds like deja vu all over again with the 2010 repeal and all of the changes that are going on. So let's take a look at what can happen if we have new administration for the upcoming year. Next slide, please. So first, let's talk about a potential Trump estate tax proposal. What if Trump has the victory in November or December or whenever we finally know what the results are? What's the estate plan going to look like? Well, Trump was the one to sign the Tax Cuts and Jobs Act into law, so it's a safe bet that he'll probably look to extend that. So where we have a 2026 sunset provision, it's quite possible that he might get that to even stretch out into the future. He's also been known to call for a complete repeal of the estate tax. So that's something that might be proposed. That really seems unlikely that that'll happen anytime soon, though, because of all of the increasing deficits and the increasing costs that we have with regards to the COVID-19 stimulus bills. And from an income tax perspective, we'll likely see the continuation of the lower tax rates for individuals and corporations under a Trump administration. So let's look at the other side. If you'll go to the next slide. What about a potential Joe Biden estate plan environment? Well, Joe Biden has previously discussed repealing the step-up in basis at death, resulting in a carryover basis. So what this means is if I die and I own, let's just say, AT&T stock, and on my date of death, it's worth $100 a share, but when I bought it, it was only $5 a share. If the step up in basis is repealed, then whoever inherits that keeps that $5 basis. And when they sell that property, then they're going to pay a capital gains tax on that appreciation. Current rules say that if you have a step up in basis, your heirs get that property at your inherited basis of $100 a share. And so if they would turn around and sell it immediately, there would be no gain on that sale of property. So that is one of the things that has been discussed, is repealing that step up in basis. Another item is a deemed sale of assets when gifted or death. So right now, under our current laws, you can gift assets up to the $11.58 million without having a gift tax situation. Under a deemed sale of assets, if I were to gift somebody $1 million worth of stock, then at that point it would be called a sale, and we would recognize that gain immediately and pay tax on that. So that's what that provision would mean. In addition, Joe Biden has supported increasing the estate and the gift tax rate. So where I showed that the estate and gift rates were at a high of 55% back in '97, and even prior to that, they were even higher than that. So we've gone from a 55% and higher rate down to a 40% rate. He has proposed increasing that. And right now we have a unified gift and estate exemption amount, meaning that, again, like I said, I can give $11.58 million anytime now while I'm alive or on my death, and that number is the same. This proposal would be limiting what you can give during your lifetime. So even if you had an $11 million exemption for estate tax purposes, you could possibly only gift up to $1 million during your lifetime. And then the last provision on there is to increase the long-term capital gains tax rate to 39.6%, which was the top individual tax rate prior to the Tax Cuts Act, for individuals that are earning over $1 million a year. So you can see there are definitely some significant differences in those two proposals. Next slide, please. So what happens if the Democrats sweep the legislative branch and the presidency? One of the things that we are hearing discussed a lot lately is that the possibility of the 2026 sunset might actually take place as early as 2021. Now, does that mean on January 1st of 2021, we're going to know what that law says? Not necessarily. What that means is come July or August or April or May, whenever Congress gets around to it, it could be that they decide that they want that provision to no longer be set at 2026. They want it stopped immediately. And rather than doing it on the day that the law is signed into law, or that the bill is signed into law, they might make that retroactive back to January 1st of 2021. So, and in light of the government needing the money to pay for the $1 trillion economic stimulus packages, this is something that could possibly very well happen. So what that means is we can't wait until after the elections. We can't wait until the law changes and Congress makes up its mind. We need to start thinking about this now so that we can have the steps and the documents in place so that if that change comes about, we're ready to take advantage of that. Next polling question, please. So do you expect to have a taxable estate if the exemption sunsets to the pre-2018 amount of $5.8 million versus the $11.58 million? And we'll give you a couple minutes to answer that. Okay, so it does look like some of us are going to be a little more concerned if we do revert back to those pre-2018 amounts. And for some of us, it still might not be an issue, but you want to make sure we still have your documents in place that spell out what you want to happen to your assets in the event that, you know, something would happen. And so with that, I'm going to turn it over to David Shallenberger, who's going to continue with giving us some planning examples and recommendations.
Thanks, Inez. You know, kind of to start here, you know, you went over what may happen in the future with the laws and what's going to change. The IRS has already addressed a little bit of this for the sunset provision, and that they came out in 2019 and said they're not going to do a clawback. That's a concern for, you know, especially the sections of our group here who would expect to have a taxable estate should, or rather when the exemptions fall back to the $5 million. So they're not going to try and change that for actions that may have been taken under a more generous law, which gives us some time yet then to actually take some actions between now and the end of the year if we are concerned and maybe have not taken some actions. What they have stated, though, is essentially that we will have a use it or lose it scenario. So much like the year that the exemption went from, or we had no estate tax or a $5 million rule, the IRS is kind of saying, okay, this is how we're going to handle it, and it will be, you know, if you've used it, we won't penalize you. If you have failed to use it but before the sunset, then you can't go back and change things. So if I can get this next slide. Oh, I went too far. What can we do now? And this, I think, applies for those who expect to have a taxable estate under the sunset provisions, or perhaps even those who may not. It's a good idea to know how you want your assets to be handled after your death, no matter what you're doing. So, you know, it's a good idea to take an inventory of your estate. If you know what is in there, what its values are, and as you're doing that, get an understanding of what you think, what assets you have that may have the potential for growth. Those assets that have potential for growth in the future may be good potential candidates to actually start giving to the next generation or taking action on. Other things to do are, you know, review your beneficiaries. And by this, I don't just mean beneficiary of trusts, but rather, you know, who receives the proceeds from your life insurance policies. Also, you know, what about your IRA or 401k accounts? All those plans have the ability to name a beneficiary after your death. And if you leave that blank or unaddressed, either the plan or state law will rule as to how those assets, not only who they go to, but how they will be paid out to your beneficiaries in life. And the consideration there is, you know, especially with the IRAs, with the Secure Act that was passed, you know, we used to have the ability to stretch those payments out when those parties were named over a longer period of time. Well, now they're going to mandate how quickly you have to take those assets out of your IRA account. So we can't stretch it over long periods of time, but we can still identify, you know, who should be receiving it when that happens, or when the eventual event occurs. Other things that we can do are utilizing the current lifetime gift exemptions and maximizing our gifts to try and reduce the size of our estate. And again, identifying and shifting out those assets that have high potential for growth. Planning ideas that we should be considering now would be outright gifts. Those are simple to do. You lose the control of the asset. There may not be any creditor protection if you're just giving it directly to your children. There's also going to be some income tax on the assets of the recipient there, or you can do it indirectly with gifts into a trust. This does increase the complexity, but it allows for greater control. There can be limitations on creditor access. You know, considerations here might be if you have a child who has spendthrift concerns where, you know, they have difficulty managing their own money. You know, you can name the trustee of the trust who's going to limit or has the ability to limit the child's access to the funds within the trust. And there's also a lot of tax planning flexibility, which we will get into later in the presentation, where we can continue the estate burn by having actually the grantor pay the income tax on the income that's generated from the funds in the trust. The trust planning vehicles, you know, just to start here, we've heard a lot lately about spousal lifetime access trusts. What these are is an irrevocable gift to a trust where the grantor's spouse and often some of their descendants are named as beneficiaries. This is a very flexible agreement. It allows the spouse access to the funds if they're needed, and, you know, locks in the lifetime gift. And then by giving the spouse the access to the funds, often, you know, they can be used eventually or essentially by the grantor by way of their spouse's access. There is a bit of a cautionary tale here, though. If the beneficiary spouse passes away prior to the grantor spouse, it can cause issues with the grantor spouse being able to benefit or use those funds. The same thing can occur if there's a divorce. So these are not recommended in cases where there is a difficult marriage or marital situation, but you know, they are, I would say, probably gaining more speed lately so far as what we've seen here, and more folks are using them. You know, one provision that can help with some of the access issues is that, you know, these can be set up where the grantor is allowed to borrow funds and has to repay them back to the trust over time. You know, the next type of trust that we do see here is a grantor retained annuity trust. What this does is a gift is made to trust, and then we actually decrease the value from the fair market value because the grantor is retaining the right to an annuity over time. These were limited to a degree during the Obama presidency, as the term and length of time that these had to be in place, many more restrictions were put on those, but they're still a really good tool, especially if you've got an asset that is going to highly appreciate or generate a lot of cash. You know, in my world, I've seen these used with business interests that own oil and gas wells, where those oil and gas wells are generating cash. The cash generated there can actually pay the annuity back because the investment in the well itself had already been made. It's a little bit less exciting these days because of the current pricing in the market for gas, but we have seen them work in the past. And then what happens to these after the primary term? So the primary term being the period of time that the annuity is paid out to the grantor. After that, the assets either go, you know, directly to the beneficiary, or in some cases they can be set up so that it falls into a successor trust for that beneficiary. So there's still a lot of other limits that can be put in place there.
I'm going to add here, David, just that if you have an ultra high net worth and you've used most of your current unified exemption amount already, these short-term grants are a good way to not use up any additional gifting or exemption amount. You keep them short, you end up essentially having a zero gift amount. But the idea is that if the growth rate can increase more quickly than the interest rate that is imposed up on us, which as you can see right now is a 0.4% for September, is the IRS 7520 rate, which is used, then at the end of a short term, such as 2 years or so, there still could be assets left that are transferred to your beneficiary. So in the event that you've utilized a lot of your exemption, this might be a way to continue to shift some of the appreciation.
Yes, thanks, Inez, for going into kind of how that works. Again, these are really good for highly appreciating assets, especially assets that not only will appreciate but will generate cash. You know, the next tool that we're seeing more and more of these days is the use of dynasty trusts. Dynasty trusts are really, they're great tools, especially when we're talking about multi-generational wealth transfer. Again, this is a long-term trust, given that consideration. It does help protect the assets from creditors. So There seems to often be concerns about when we're talking through multiple generations, the number of people and just odds are in those considerations. Someone may get sued or become a spendthrift for whatever reason. So that's a very nice tool to have. The control over the trust property is pretty strong in the grantor's level. They also can be designed as grantor trusts, and a lot of these other vehicles can be treated as grantor trusts. What that means is that essentially the grantor gives up the property and the right to use of the assets. However, they're still going to recognize the income on their personal returns, kind of like I said earlier. And so what that does is you make a gift, let's say of $1 million, but that $1 million continues to churn out, $100,000 of income each year. Well, each year that the grantor recognizes that income, they pay the tax with their own remaining personal assets. They continue to burn down, I think is the term, their estate. So in that case, if they're paying 25% of that $100,000 each year, essentially they're making an additional gift, a non-taxable gift of about $25,000. The other type of trust that I like to or often see combined with the Dynasty Trust, we see it with the Spousal Lifetime Access Trust that we mentioned earlier, is an ILIT, which is an irrevocable life insurance trust. By adding that feature, in a lot of ways, we're just allowing these trusts to hold and become benefit from the life insurance policies that the grantor may have set up. If it's a new policy, these trusts can purchase, the life insurance and benefit from them without much problem. If there is an existing policy that the grantor has, the grantor is allowed to transfer that existing policy into one of these trusts. It's just that you have to survive that transfer by 3 years in order for the proceeds from that life insurance policy to not be included in the estate. So there's a little bit of issue there so far as transferring existing life insurance policies, but it's certainly something to consider. One thing I did fail to mention when I was talking about the grantor aspect of these dynasty trusts is it can be a little bit uncomfortable from a cash flow perspective. So as I mentioned, the grantor pays the income tax for the income generated by a trust that they can't access any of the funds within. It does reduce, the idea is to burn down their estate. Well, people aren't used to necessarily, having a negative cash flow environment because, they've moved an appreciating asset into the trust. They're not receiving funds from the income it's generating, yet they're, responsible for paying the tax. That is not something to be entered into lightly because, again, you're paying tax on something that you're not really benefiting from. But the idea is that you continue to burn down your estate. Most of the time when that feature is set up within these trusts, if not all of the time, that can be turned off. So, in situations that I've seen, it's like, okay, let's give this a try for a year. Let's, make sure you're comfortable with it and we'll evaluate it. And we'll make it 2, 3, 4 years. And inevitably the business that has been given into the Dynasty Trust has been, profitable. And so there's more tax and more tax paid each year. Well, the grantor often gets uncomfortable, like, hey, where's the rest of my assets going to go? People in the situation to be using this are often savers. And so it's uncomfortable to see that cash flow go out when they're not benefiting from the income itself. That's just something to be aware of. That is kind of the intent of these things, is to use up some of those other funds from the savers. And when it becomes time, we have turned them off. So, and by that, I mean, we make the trust begin paying the tax itself. So on the succession planning side of things, it's not too late to start now, whether we're in a taxable estate situation currently, in a taxable estate situation under the sunset provision, which reduces the lifetime exclusion amount, or just knowing, hey, this is the direction that I want my stuff to go. It's not too late to do this. With COVID, business values in many situations, especially volatile industries like oil and gas, hospitality, or entertainment, their asset values are depressed. And we expect that to come back in the future for many of those businesses. That could be the exact type of asset that we're talking about that we would expect a lot of growth from once we get out of the current environment. Those types of assets are the types of things that I would look to start moving. Many clients are, especially younger clients, and by that I don't mean necessarily 20s, but those that are still active in their businesses, may be hesitant to give away a piece of their business to their younger family members. Sometimes that's related to control. I would say, don't let that necessarily hold you back. There are other opportunities to limit the amount of control that is given up when transferring wealth to the next generation. The idea is to kind of sit down and look through, is it appropriate financially to start transferring some of these assets? Other tools that I did not discuss earlier, if I can get the slide to change here. There we go. If you're charitably inclined, there are some different types of trust that you can use, one of which is the charitable lead annuity trust. That's where the trust is funded, and annuity payments and a lead trust actually on an annual basis are paid out to the charity of your choice. At the end of the term, the remaining property then would pass on to the remainderment. The remainderment are people that you would choose, your beneficiaries. Often that is, the next generation. The idea there is to use up as much charitable contribution deduction as you can in any given year when you do that. The other juxtaposition on that, though, is how much charitable giving do you want to do in any one year? Sometimes, especially with the limitation on state and local taxes, people may be in and out of being able to utilize their Schedule A deductions. So you may want to bunch them. The other prospect is, do you want to bunch them into 2020? Do you want to bunch them into 2021? Depends on, kind of which way you're leaning or thinking the election may go and tax policy thereafter. So it's a good opportunity to maximize some of those things. We've been talking a lot then about, federal taxes and everything else. Ohio, which is where I'm located here, has gotten rid of its estate tax, but many folks around may have issues in other states. Trust income taxes, as well as estate gift or other types of transfer taxes, are determined differently in lots of other states. So some cases there'd be an inheritance tax, sometimes there'd be a gift tax. We didn't get into that, but those are some other considerations to start thinking about. When Ohio had its estate tax, for instance, the exemption levels were at a much, much lower value. So there was a lot more planning involved to try and limit even what the state of Ohio was going to tax. So it's something to give a thought to. So if you already have an estate plan, that's fantastic. I do think that now is a good time to kind of go over that with your professional team to make sure that everything that's going on there still makes sense. That's everything from the financial side to what Inez mentioned earlier with regard to other documents that, you know, your powers of attorney or medical health directives. We're thinking about it now, a lot of folks, because of the issues with COVID, but what other times should we be thinking about reviewing that plan? I advocate that anytime that there's a major life event, that would be anytime, you know, a child or perhaps even grandchild is born, deaths, marriages, divorces, major life events. You should kind of look at that and make sure you're really doing what your documents direct what you really want. The other time would be if there's, you know, a significant law change, like what we expect to come up here on this, either in the sunset, or if the Democrats get in and change the way things are done, it may be even sooner than that. Or if there's a significant change in your financial situation, you know, either a spike up or a spike down is not necessarily a time to panic about, hey, have I done anything? It is certainly a time to review if you've already started something. If you've not started, it's a good time to start, you know, today, especially as we're looking at the prospect of what happens in the future, and no one really has a clear crystal ball knowing exactly what's going to happen. So if you already have a plan in place, you know, net worth in the $11 million range and above, you know, if you're not doing something, start the wheels in motion now to try and take advantage. If you are doing something, are you taking complete advantage? If we wait until after the election, or certainly after the sunset provision, we may be missing out on some opportunity to transfer some wealth. As I mentioned, kind of with the Dynasty Trust, it's not just necessarily looking at transferring wealth out of your hands to simply the next generation. You should also consider, you know, the generation that follows that as well, which is and utilizing the GST exemption, which is a generation skipping tax. I would recommend, you know, considering, is your plan going to put your children in the same situation, or are there things you can do maybe to divide that wealth amongst the generations so that no one, or rather none of your children have to worry about it at quite the same level, which I think leads us to the whole question number 3. Do any of the planning strategies mentioned today interest you? Monty, if you could pop that, thank you. Give you a second or two.
And while we're doing the poll question, I would like to add a couple things just quickly that came to mind. One of the reasons why we keep stressing plan today, if you're going to gift business interests, things like that, those are going to need to be valued for purposes of filing your gift tax return. And we don't want to wait until the last minute to get the proper people in place to do those valuations that need to be attached to your gift tax returns. Also gives us the idea of how much the business is worth, so we know what amount we're giving away. So that's another reason why you really need to start thinking about that today, because of valuations. And then the other item I thought of is, whenever some of you had said previously in the poll question that you already have an estate plan in place. And while that plan might not be as flexible because it might already have irrevocable trust involved, there are opportunities to possibly decant some provisions in trust. That is not something we as accountants do, but that's something that attorneys are able to work within state law sometimes, so that you can get some of those older provisions, the ones that aren't so user friendly anymore, the ones that you might not like, try to basically get those out of the new trust document and keep the good stuff. So if you have an irrevocable trust, don't think, okay, I don't need to look at this, I can't change it anyway. There are opportunities out there, if it makes sense, that could possibly still provide you with some planning opportunities.
Yeah, and in fact, Inez, specifically with regard to that decanting, there have been a lot of changes, at least in Ohio law, that we may want to take advantage of since those original documents were set up. I would say there's a lot more flexibility today in Ohio estate law than there was, when I even first started my career. So it's time to go back and review those, and the capability of decanting, like you said, is not something we do here. It's an analysis that could be gone through and may better direct how the grantor wants those assets to be used through the life of that trust. So with that, I think we had the polling question. Are there any questions, Imani, or from the audience there?
Yes, so we have a few questions here. The first question we have is, since 401ks, IRAs, etc., live outside the trust, does the pour over clause in the will cause them to pour into the estate?
I'll take that question, and that would be a no. If anything that has a designated beneficiary attached to it passes by what we say is a contract. So for your 401ks, your IRAs, your life insurance policies, any of those things where you're listing beneficiaries, unless you are specifically saying to my estate, which is not usually a good idea, you don't generally want to leave a 401k plan or an IRA to your estate. But unless it does say that, then it will not go through a probate process. It will not pass by will. It will pass directly to your beneficiaries outside of any trust or will or any other plan you have in place.
Yeah, and if you have not designated a beneficiary, I believe that will actually pass to your estate in most cases, at least here. So that's kind of one of the reasons why, I would recommend looking at your documents and seeing, have you designated a beneficiary? Because you certainly would at least want to be able to name that, because like Inez said, it's usually not a good idea for the estate to become the beneficiary of those assets.
And
Great.
sometimes if you haven't looked at those documents in a long time, you might have people on there, for example, before I had children, I would have had my parents listed on there. Well, my father is now deceased. So if I have him listed, then there's just a whole can of worms that then you have to go through a process showing that he's pre-deceased, and then what happens from there. So definitely now is a good time to go back and look at those designations.
And that's also a good point there. Look at, often those plans will allow for a primary beneficiary and also a contingent beneficiary. I would recommend really looking at both of those lines and making sure that, just in case of the scenario that Inez mentioned, that the contingent beneficiary be named so that there was less of an issue at that time.
Awesome. Thanks, guys. The next question we have here is, does the unified gift tax exemption during your life have to be done in one transaction, or can it be done over multiple transactions?
Yeah, it can be done over multiple transactions. It's a lifetime amount. Part of the reason why perhaps we're talking the way that we are is because of the amount of time with this less than clear crystal ball that we have. It certainly is not something that has to be eaten into all in one foul swoop.
In addition to that, you also have an annual gift amount that you can do each year. $15,000 is that amount for 2020. So you can give $15,000 to anybody, and as long as you stay under that amount, you wouldn't even have to file a gift tax return. So that's something we probably failed to mention, but that's something, especially if you're in an estate tax situation, you should be gifting that $15,000 or whatever that amount might be on an annual basis, just to continue to burn down the size of your estate.
Great. The next question we have here is, how do you typically prove fair market value when it comes to gifted assets that are unique and open market values are not easily accessible?
Well, situation like Inez said earlier, if we're looking at, business interests, closely held business interests, a valuation has to take place by a professional that does that type of work, a certified appraiser there. In the case where, you may have unique art, there is someone that has to provide the documentation as to what the value or fair market value of that asset is. And then, logistically, when we file the tax return, that proof often has to either be in the file or be attached along with the gift tax return when that is sent in. And that process is the same whether it's transferred during life as a gift or if it's transferred at the end of life as a part of the estate.
Great. And last question here, if you guys have any more questions, be sure to submit them into the chat box. If you are married and have assets between $5 million and $11 million, and if the exclusion amount was $5 million, do you need to separate your assets into two trusts to take full advantage of the exclusion amount?
At the current time, that is no. We now have what we call portability, in that it used to be, back when I first started, that you did have to split those assets because each person only had that 5.8 million or whatever that number was to give away. And if you didn't have enough of those assets in your name, then you basically lost your exemption. But a recent law change has allowed for portability. And so now, if I'm the first spouse to pass away and I haven't used my $5.8 million, then my executor can file an estate tax return and basically give my exemption amount to my spouse, who can take advantage of that amount as well. So that is no longer the case. Depending on the size of your estate, portability may or may not make sense. You still might want to do what we call the typical AB trust, but I don't want to muddy the waters. I'm just going to leave it at that you do not have to separate those assets, but sometimes it's a good idea and sometimes it's not.
And Inez, does that portability feature or function of the law, does that sunset as well?
I do not believe that sunsets. That was pre-TCJA. That is not set to sunset.
Awesome. Thanks, guys. Do you guys have any final remarks before I close it out today?
All I can say is from what I saw, there were a lot of people that were signed up for this webinar, which tells me that it's on people's minds heavily now, with probably especially in light of the COVID situation. And so I'm glad that people are starting to think about it and take consideration, and just, again, pull out your documents, see what they say, get us involved, and we'll just make sure that everything still is the plan that you hope to have in place.
Yeah, and what I would say is we focused a lot on the financial aspects. We did go over some non-financial aspects of this. A large proportion during our poll question don't necessarily expect to have a taxable estate. I think it's worth reviewing those documents like I said, anytime that there's a major life event, COVID included, not just for the financial aspect of the estate plan, but also to make sure that, you know, what you desire is what's going to happen, you know, with the medical items, or particularly with, you know, the custody or guardianship of children, you know, things like that. So it's not just on the financial side, there's also some non-financial things to be considered there.
Awesome. Thank you guys so much. And thank you for joining us for today's webinar, Shifting the Business Infrastructure, How COVID-19 and Election Results Can Influence Your Estate Planning Strategy. We hope the team was able to provide you with some valuable insight that will make sense of the current government recommendations stemming from the COVID crisis. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Inez and David directly. You can also contact any of our RAY team members by clicking on the People section of the firm's website at www.raycpa.com. That's REA. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webinar, and more. Thank you. We hope you guys have a great day.
Thank you.